Mutual funds are subject to market risks. Please read the offer document carefully before investing. We've heard this countless times, haven't we? It's scary, but it's a legal obligation. Mutual funds are very good vehicles for beginner investors, and the best part is that you can invest as little as 1,000 rupees per month. So let's get started. Think of a mutual fund as a giant vault. Everyone puts in a small amount of money. The vault manager, or the mutual fund manager, invests the money in the stock market and the debt instruments. So what are the benefits? Some obvious ones are professional management. Mutual fund managers have decades of investing experience. Then there's diversification. Now, fund managers will spread investments across various stocks to spread risk and maximize opportunity. And last is ease. You open an account with the mutual fund and can withdraw whenever you wish. It's like a piggy bank managed professionally, which you can take out anytime. So what's an NAV? Imagine thousands of people investing in mutual funds. How can you keep track of the progress? For this purpose, mutual funds are sold just like shares called NAVs, or net asset value. Say you invested in a mutual fund when the NAV was rupees 100 and exited at 110. That's a 10% profit. Yes, exactly like a stock. Now, there are different kinds of mutual funds. We have equity funds, there are debt funds, balance funds, and exchange-traded funds. Let's see them one by one. Equity funds are simple. They focus on equity, that's stocks mostly. Here, the focus is investing in equity as the primary vehicle. Now, if you're young, you should focus on equity funds. Then there are debt funds. Debt investments, like bonds, are basically fixed income. You get an almost guaranteed fixed return per year, and this type of investment is good for those who do not want to take a high risk. Fixed returns usually range between 8 to 10% per year. So if you're nearing retirement and you need something fixed, this is what you should learn more about. Then there are balance funds. Now, what if you wanted a little bit of equity and a little bit of debt? A nice mix. That's what a balanced fund is. It balances both these investments together. Now, if you're middle-aged with children at about 10th grade, this is a good option to mix and match equity and a little bit of debt. Then we have exchange-traded funds. Now, ETFs for short track the index. So you can purchase Nifty or Sensex, which is already a diversified basket of stocks. So an ETF basically tracks an index like Nifty, and you purchase it just like a share. An ETF also works for gold. So if you wanted to buy gold shares, you would buy gold ETF. It basically tracks the price of gold. So what should you invest in? Now, should you invest in equity or bonds? According to financial planners, you should allocate money according to age. Let's keep this simple. If you're under the age of 30, you should be at least 90% invested in equity. The 10% can be in bonds. When you cross 30, you can place 80% in equity and 20% in debt. At 45, you should go 60% equity and 40% debt. You see, the idea is simple. When you're young, you can take risks and have time on your hands. Equity should outweigh bonds when you are young. As you grow older and you have more responsibilities, you can start balancing. Closer to retirement, you should almost mostly be in bonds. So when should you invest? Here's the short answer. Now. Think about buying a house or gold. If prices fall of these two assets, you would obviously think it's a good time to buy. If prices rise, you would buy anyway because gold and houses, well, are just good investments. You see, we give houses and gold the benefit of time and the benefit of doubt. Do you do the same with stocks? Give them time and they will show you profits. At this stage, you should not think about timing the markets. Start investing slowly every month. Consistency is key. This is the average of 30 stocks, also known as Nifty. Look at the returns it has produced. In the long term, healthy companies will always be profitable. The black swan. These are disaster events. What if your stock crashed? Come on, you've thought about it more than once. Yes, that can happen. A black swan is a one-time extraordinary event, such as the case of Satyam. It was the largest, most respected company in India. Everyone agreed it was truly blue chip. However, a financial scandal caused it to plummet from rupees 550 all the way down to rupees 100. Now, such a fall can be avoided if you use the intro to technical analysis method or even diversification. Now, diversification basically means you're buying many stocks with the capital you have. Now, let's say you have a certain amount of capital. You can buy 15 stocks. If one of them experience a black swan plummet, you will also find huge wealth creators like Dr. Reddy's going from 1400 rupees all the way to 4000. The bottom line is, do not worry about one-time events. By investing in several companies, you're diversified and protected. Equity is, and always will be, the highest yielding investment. Now, like a lot of financial products, this can get very confusing. It can get confusing to buy a mutual fund. So let's understand the most important aspects. This is enough to earn a decent return, far outpacing most investments. Let's assume you're below the age of 35 and you're looking for equity. On moneycontrol.com, you can get fairly good comparison of mutual funds that are sorted by grade 1. Now, grade 1 mutual funds are rated by a company called CRISIL. They basically give ratings to companies. Here, we have funds based on size of the companies they can invest in. Large cap means large companies like Reliance or Bharti Airtel, small, mid-sized companies. Diversified is a mix of all type of good companies. Thematic funds invest in specific sectors like the oil sector or the pharma sector. You should avoid this since sectors move in cycles and there's no reason to invest in a specific sector unless you have good reason to. ELSS is an equity-linked savings scheme that saves up to 45,000 rupees in taxes. And finally, we have ETF. An ETF is an exchange-traded fund. Basically, it allows you to invest in an index such as Nifty. So if Nifty goes up 10%, the fund will go up 10% as well. You're basically investing in Nifty through a mutual fund. The rest is debt. These are all fixed income funds. As you know, this section is for low risk, almost guaranteed returns. Now, which one should you pick? A simple strategy is to buy this, a diversified fund. You can see the NAV. That's the price of the fund you can actually buy at. This is obviously the 1-year return, and the AUM, that stands for Assets Under Management. This is the total amount the fund is managing. Let's, for comparison's sake, say ICICI Pru Value Discover Fund. This is a diversified fund. You can see the fund returns, but don't be fooled by just a few months. We need to go in deeper. Let's see a 10-year return. You can change it right here and click Go. This is my favorite example. Say you invested a few months before this infamous crash. That's at about rupees 33. Your money would have lost about 50% of its value in this big fall. But if you held on, 5 lakhs invested right before the crash would be worth 17 lakhs in just 7 years. We're going to compare the ICICI Diversified Fund and the Nifty ETF. Now, in the US or any other developed nation, the index usually does the best. It's the informed market with professional investors, and there's little room for deviation. In India, things are slightly different. Stocks still outperform the index overall, and I'm going to show you this. From 2005 to 2015, ICICI Diversified went from NAV of 16 to an NAV of 115. That's a 618% return. This is a diversified fund. From 2005 to 2015, the ETF fund went from NAV of 196 to 820, a 318% return. So the diversified portfolio did twice as better as investing in the index. That's a big difference. I want to show you one more thing about mutual funds. This is the Birla fund, and as you can see, this is diversified as well. It too has given decent returns over the last 10 years. Now you can basically choose any fund and maybe even spread out between 2 or 3 funds, but just keep it simple. But the question still arises, what if you just wanted to invest really small, just a few thousand rupees? Then what do you do? The answer is with the SIP, or the Systematic Investment Plan. It allows you to choose a mutual fund and invest as little as rupees 1000 per month. Now, ICICI Bank and SBI have good SIP mutual funds which you should start your research with. Now, SIPs are like saving accounts. You put a small amount, and when you want to withdraw it, you can. Usually, there is no lock-in period. A written request is all it takes to withdraw the money. Go to your nearest bank and they will connect you to their mutual fund department. Now, that's all you need to know. We can overcomplicate this by adding tons of information, but personal finance is about starting now. That's the most important thing, and to keep things simple. Pick a mutual fund which is diversified, has had a better return against Nifty in the last 7 to 10 years, and has a higher than average asset under management. You can invest a lump sum amount with a few mutual funds and also start a small SIP on the side. You can mix and match. Make sure to share all mutual fund information with family members on their email and Google Drive. Thank you for taking the course. This is just the beginning. All the best on your journey to financial freedom.